So we have some pretty urgent information to bring to your guys' attention. You did see some bad data as far as inflation goes. This next inflation report happening next week might not be so pretty. You've also heard of a lot of Fed speakers over the last couple of days that have been reiterating potentially we're going to have to get a higher terminal rate. Does that mean someone knows something? They potentially already know what the inflation report's going to look like, and they're trying to get the markets ready for more hawkish verbiage. Who knows? We'll discuss it here in this video. On top of all of that, you are going to get some smaller economic data coming tomorrow with the initial jobless claims. And you do see Carl Icahn, legendary activist investor that does have that very large short position on the S&P 500 that does expire next Friday, worth $5 billion. So let's get into all of this information. If this is your first time to the channel, subscribe to the channel if you learned something out of this video. But either way, all of you guys, hit that like button if you are currently watching the video. So let's get into it. What happened today on Wednesday? The S&P was down about 1%, and there's a couple different reasons for that. A lot of it, I would say, has to do with the Fed and reiterating this point that the terminal rate might be higher than what the markets are pricing in, around 5%. So the markets are starting to get a little bit fearful about that. Now, we do have economic data coming out tomorrow, and that's kind of the more urgency of this video. But then more importantly, next week, you're going to get CPI, and that's going to be on Wednesday. Now, you got one data point that came out today, which is not good for this upcoming inflation report. And let's talk about that first things first. And then we'll get into a major activist investor that just took a very big short position on the market. So you're looking at the Manheim Used Vehicle Value Index. Now, this is basically showing you how used vehicles have appreciated or depreciated in price over the years. So when this chart is going up, that is not a good thing for used vehicle prices. Well, this would be the COVID crash, the COVID drop, and things got pretty cheap here for a minute as far as used vehicles. And then it pretty much consistently went up after that. And this part right here, about halfway up the chart, was where inflation got to 8-9% year over year. A lot of it did have to do with used vehicles, because used vehicles is a decent weighting of the actual inflation report. Well, it's been coming down the last 6 months. Consistently, every single report has been lower. Well, now look at what just happened. This came out today for the month of January. You've seen a sharp uptick in the price of used vehicles. This is going to negatively affect the CPI reading that we get next week. Now, you're also seeing Carl Icahn. You might know him for many different reasons. We'll talk about kind of that whole situation, because Carl Icahn is someone that shorted AMC, shorted GameStop, that lost money initially the first round, and then continued to short the stock. This was one of the players that has never really publicly closed out their short position. So they're probably still open. At least I haven't heard anything about it. But you can pull up numerous reports that they're shorting AMC and GameStop. Pretty easy to find. But overall, he's an activist and investor. So a lot of people pay attention to what he has to say. And if you guys don't know what an activist investor is, it's basically a investor. A lot of times they're multi-billionaires, right? They got a lot of money. They come into a bad company, call it Bed Bath & Beyond. Or even what Ryan Cohen did with GameStop in a certain way. You come in to be an activist investor to enact change, and a lot of the time, I mean, your goal is to either take over the company or to really turn things around. So he's seen as a real influential person, call it that, in the money manager atmosphere, right? Call it Wall Street. A lot of people pay attention to what he does. Now, Carl Icahn just paid $50 million of premium for February 17th S&P 500 4,050 puts like 4,050. It equals out to 405 on the SPY index. A $5 billion notional short position expiring 3 days after CPI. So he's putting out this trade, which is a very big trade, basically betting that CPI is going to go higher. That's the only reason that you would make this trade right now, because that's the only thing that could really derail this market, especially what we have just heard recently from the Fed. The Fed has said if inflation goes up or if economic data, continues to impress, 500,000 jobs a month is definitely impressing everyone, then they're going to have to raise rates higher. Now, a lot of people might argue, and this is where you could get into some conspiracy theories, and I think this is actually quite relevant. The Fed just, as of the last couple of days ago, right? Just the last couple of days have been pushing this notion of taking the federal funds terminal rate higher, maybe to 5.5% or maybe 6%. You've had some numbers thrown out there, but the Fed's really pushing away against this pause, against the cut, but even against one more rate hike. They're saying ongoing rate hikes. You have had Fed Waller today, Fed Jerome Powell yesterday, that have said the same thing, as well as some other Fed members. Fed Kashkari has also said the same exact thing. Now, is it too crazy to think that the Fed knows what the CPI report is going to come out next week, and he wants to prepare markets for that now? Is it also a huge conspiracy theory that Carl Icahn might have some pull at the Fed and might know this inflation report is going to come in bad? I don't think that's a far stretch. It is February 8th, so after all, if you're calculating inflation data for January, you're probably done with that. You're probably just waiting to put out the report. I doubt they're calculating anything right now. It's already done. So it wouldn't surprise me that the Fed knows what this data is going to look like. After all, Fed Jerome Powell admitted that sometimes he gets data a day or two before it comes out. Maybe it's a week this time. Maybe it's a couple extra days. Either way you put it, I think it's setting a bad precedent for the next CPI report next week. And it could set the markets up for some pain in the short term. That's why I'm telling you guys this now. If you know how to trade this market, maybe there is some potential for you there to do so. If you guys want access to all of my trades in real time, link down below in the description of this video. A great place to be and would love to have you. Not supposed to be financial advice. It is simply what I am doing and what I am looking at. Things like this that not everyone's going to like, right? Broad market things, what the data is looking like around CPI, and specific trades, right? Not everyone likes that. So we like to do that over in that community. So it's not looking too good for next week. We will just call it that. Now, as far as tomorrow, the economic data that does come out, and tomorrow is Thursday, you're going to get initial jobless claims for February 4th, expecting 189,000 initial jobless claims. That is at 8:30 in the morning. If this number goes higher, that is going to be a positive thing for the markets, and the markets are going to rip. If this number comes in at expectations or even slightly under that, it's going to continue to show that the labor market is still running red hot, and the Fed will have to raise rates even more. And not to confuse you guys, I've been saying since the start of 2023, when the markets have been reacting positively to positive economic data, that was all with the notion that the Fed's going to raise rates like one more time and be done, right? The Fed's reiterating that even good economic data is not enough. You need to see inflation coming down, and you need to see economic data start to weaken. And that's something the markets have not really expected. The markets have been under this impression that if inflation continues to come down, if economic data starts to come in good, well, that's a good thing. That's a soft landing. Fed's over here telling you, no, we need inflation to come down and we need the economy to weaken. We don't even care if inflation comes down and the economy does not weaken. You need to see some weakening. So not a good thing. It will make initial jobless claims tomorrow that much more important. And then on Friday, you're going to get the big data point of this week. That is the Michigan Consumer Sentiment Preliminary Survey for February. The important parts are the Michigan 5-year inflation expectations and the Michigan inflation expectations for 2023. You're expecting these to come down by about 1/10 apiece, like 1/10%. Pretty reasonable, right? If they go up, that's going to be a big problem for the Fed, a big problem for the markets. As far as tomorrow and earnings are going to get in pre-market, Pepsi, AbbVie, Canopy, Philip Morris, Hilton, Kellogg's, Duke Energy, Toyota, Cameco, and Veru. Thursday and after hours, PayPal, Cloudflare, Lyft, Expedia, Aura, Dexcom, Bloom Energy, Alteri, Yellow, and Energy Partners LP. And then on Friday, you got a lot of random companies, but you do have Honda squeezed in there. So now that you guys got a lot of this information that I urgently wanted to go over with you guys, the Carl Icahn short position on the S&P 500, which granted does not give a lot of time. That's just next Friday. That is 3 days after CPI comes out on Wednesday. That is preparing for a pretty decent market pullback. And considering those options would have to get in the money, you're probably looking at a 403, 402 break even on those options. That's a pretty bearish bet for the next, call it 7 to 10 trading days. You also have the bad inflation data. The used car index just went up again. Not potentially going to be a great thing for the inflation report. You have hawkish Fed speakers prepping the markets for a higher terminal rate. Now, the S&P 500 has rallied extensively in 2023. It's been one of the most aggressive rallies that you have ever seen in the history of financial markets. So, let's go with a bad case scenario. What could happen to the S&P if inflation does come in too hot? And the first level that I would target is going to be this downtrending level of resistance that you had seen approached and rejected from 1, 2, 3, 4, 5. It was 6 times in 2022, and we have since broken above that, right? But that's probably going to be your first level of support. And that's going to put you roughly about 398 on the S&P. If it's a small inflation increase, that's probably what you're looking at. If you get a off the charts kind of inflation report, which I don't expect to happen, then you're probably going to approach that 380 level on the S&P 500, because after all, earnings were decent. So I don't think this is going to be something that pushes you down to the lows, but potentially it's possible. It's possible. A lot of people were in a lot of short positions heading into 2023, and part of this rally that you have seen, historical rally, has been due to a short squeeze. This is actually a larger short squeeze than what you've seen in 2021 when stocks were popping off left and right. This market is a much larger short squeeze than even then. So to put that into context, that could mean potentially not a lot of people do have downside protection. If people feel like they need it, that's where you could flush out to 380 or even lower than that. I would find that hard to happen, but it is possible, guys. So those would be the levels that I would watch for any downside from here. Unfortunately, the upside's probably limited by earnings. They're not coming in too bad, but they're also not coming in very good. About that 430 would be a peak to this rally, at least in my personal opinion. So that is all for this video. Hit that like button and subscribe to the channel, like I said, if you made it to the end of this video. Most importantly, enjoy the rest of your day, and I will see you in the next one.